Welcome to this business tax roundup for this month. My name's Dean Wootton. Now in this roundup we're going to go through two main things. The first is the change to the current year basis, and the second is the eligibility requirements for the fifth SISS grant. So let's start with the change in the current year basis. This is all in the so-called legislation day, where they in advance publish details of what's going to be in Finance Bill 2022. Now, Finance Bill 2022 is going to contain fundamental changes to the current year basis for unincorporated businesses, so sole traders, partnerships, etc. Now, from 23-24, all unincorporated businesses are going to be taxed on the profits arising in the tax year. You can stick with your old year end, but you'll need to apportion profits for self-assessment reporting. Now, when they want profits arising in the tax year, you would expect that to be to 5th of April, but they're okay with 31st of March. So if you've got clients that got 31st of March year end or 5th of April year end, then you're not going to see any changes. If you've got year ends which are not 31st of March or 5th of April, then you can stick with that year end. But when you report for self-assessment purposes, you need to report for the tax year, so you need to apportion. Now, the tax year 2022-23 is going to be a transitional year. You need to get from the current year basis to the tax year basis. Now, the profits that are taxed in 22-23 will be the normal CYB basis period for 22-23 plus profits from the end of that basis period to the 5th of April, minus any overlap relief you've got brought forward. Now this change or these changes tie in with MTD for income tax, which comes in from 23-24. Now, part of me thinks the changes make sense, but you can't help but think that accountants' workloads are going to be bunched around calendar quarters, because everyone's going to be reporting unincorporated businesses for the tax year. So therefore, around the calendar quarters, June, September, etc., there's going to be a rush to get all the information in. Which, if you're using the likes of Xero or Sage or QuickBooks, maybe it won't be too onerous. If, however, we've still clients using spreadsheets, etc., which you may well have with these types of clients, the smaller unincorporated businesses, then your workload will be bunched around the quarters. So let's have a look at an example. We've got a business with a year end of 31 July, and we're going to make up taxable profits. So profits to July 22, 40,000, July 23, 38,000, and July 24, 42,000. The overlap relief brought forward is 16,000. Now this client is not going to change their year end. They're going to stick with 31st of July. So let's look at the tax year 22-23. Now this will be normal CYB, so the year to 31 July 22, which is 40,000, plus the period from the 1st of August 22 to the 5th of April 23. So that's a 38,000 times 248 days divided by 365 days, which will give you £25,819. You then take off the overlap relief, £16,000, and you get taxable profit of £49,819. Now, in this transitional year, there is a 5-year spreading of the additional profits with the option to accelerate if you wanted to. Now, I'm looking at this, and it looks to me like the additional profits are 9,819. Now, if, when the legislation is all finalised, that is what the additional profits are, and they are then spread over 5 years, that spreading starts in 22-23. That's the first of your 5 years. So you can accelerate if you wanted to, or you could just let the spreading rules work. So same example, but we're now going to look at the tax year 23-24. And we know that they want profits arising in the tax year. So we've got from the 6th of April 23 to 31 July 23, that's 38,000 times 117 days over 365 days. And then we've got the period from the 1st of August 23 to the 5th of April 24. That's 42,000 times 249 divided by 366. That's a leap year. And the taxable profit for 23-24 is 40755, plus, of course, 1/5 of the additional profits from the transitional year if spreading is in point. Now, this client has chosen to stick with the 31 July year end. To me, it makes sense to change the year end to 31st of March or 5th of April, but 31st of March makes more sense. Because I don't really want all this apportioning. It just gets confusing. So therefore, I would be changing this client's accounting date, or advising them to 31st of March. I don't think it's as bad if your year end is, say, June or September or December, because obviously we need to report for MTD purposes for effectively the calendar quarters. So if I had a year end of, say, June, then I'd be reporting calendar quarters, and that would be okay for the tax year reporting as well. If it's July, then the MTD submissions aren't going to be, by the looks of it, based on your year end to 31 July. They're going to be on effectively the calendar quarters, because that's what we're reporting for tax purposes. So for the tax year, so July year ends, August year ends, October, November, January year, they don't make a lot of sense going forward. And it might be better to think about changing those year ends to the 31st of March. I would imagine a very high percentage of clients already have 31st of March or 5th of April year ends on your client base. So it's just those that don't. Look at the year end. It would be easier to be 31st of March. Now, the other main issue I want to talk about this month on the Business Roundup is the 5th SEIS grant. They've released eligibility criteria, and specifically the turnover test. Now, it's an online claim. When the service is open, I'm recording this before the service is open, but this service will open and the claim must be made by the end of September 21. Now, the SISS grant that you get will be reported on your 21-22 self-assessment tax return, as these grants are reportable in the tax year that you received them, and they are reported separate from your accounts, remember. Now, to be eligible for the 5th grant, taxpayers must have traded in 1920 and 2021. They must have submitted their 1920 tax return by the 2nd of March 21. Trading profits have got to be up to 50,000 and at least equal to non-trading income for either 1920 or the average of 1617 through to 1920. In addition, the taxpayers must also declare that they intend to continue trading in 21-22 and this is important, they reasonably believe a significant reduction in profits due to COVID-19 occurred between the 1st of May 21 and the end of September 21. Now, these are all declarations. Now, what is the level of the grant? Well, there's two levels of grants based on how much the taxpayer's turnover has reduced. And you need these turnover figures to hand when the taxpayer makes the claim for the SEIS 5th grant. Obviously, accountants can't make the claim. It's the taxpayer. Now, with a turnover reduction of 30% or more, the grant will be 80% of 3 months' average trading profits, capped at £7,500. If there's a turnover reduction of less than 30%, the grant will be 30% of 3 months' average trading profits, capped at £2,850. I'm thinking there might be some unfortunate people that are just in the lower band, but only just, and they see their grant drop from 7.5 to £2,850. There's no softening of it. It's either the 7.5 cap or the 2,850 cap. Now, if they started trading in 1920 but did not trade in 1617 to 2018-19, the grant will be 80% of profits. So we're getting this feeling that the grant is going to be dependent on how badly I'm affected, or my client's affected by COVID-19. So let's have a look at this turnover test. Now, for this turnover test, that 30% turnover test, taxpayers must compare two turnover figures. turnover obviously per the accounts. Now there's going to be the 2021 pandemic year turnover. And this is the 12-month period starting between the 1st and 6th of April 2020. And there's going to be a reference year turnover. Turnover for 1920 or 1819, and we'll talk about that later. So at the moment, we're getting a feel for these 2 years I've got to compare. The pandemic year turnover and the reference year turnover. Let's look at the pandemic year turnover, the 2021. And it's the 12-month period starting on any date from the 1st to the 6th of April 2020. So 31st of March year ends, they just use the turnover for the 12 months from the 1st of March 20 to 31st of March 21. If it's a 5th of April year end, then obviously it's the turnover for the 12-month period from the 6th of April 2020. If we've not got a 31st of March or 5th of April year end, then we need to apportion 2 years' results. And we need to arrive at, say, the year to 31st of March 2021. If we got accounts on Xero or Sage or QuickBooks, for example, then it would just be a case of putting in the date range and just saying, right, I want 12 months to 31st of March 2021. And that would give me the number that I'm after. Now, taxpayers should include the turnover for all their businesses. Obviously, the majority of our clients will only have one business, but if they've got more than one, then you must include the turnover for all your businesses. And you must exclude all other income, including the COVID-19 support payments. Remember, the SEIS previous grants do not go in the turnover of your business. They are separately disclosed in the tax return. Let's look at the reference year turnover. Now, this will normally be the turnover reported in their 1920 tax return. If this is not a normal year, taxpayers can use the turnover reported in their 1819 return. Now, HMRC gives some help as to what is not a normal year, and this could be where the taxpayer was on carer's leave, long-term sick leave, or had a new child. They might have carried out reservist duties or lost a large contract, or they could be eligible for 5th grant but did not submit a 1920 return. Now, partners in a partnership must provide turnover figures for the whole partnership. But if they have other businesses and they're adding together turnover, then obviously they must then adjust that and make sure they're only reporting their share of the partnership turnover. It'll be distortive otherwise. Now, what about accounting periods longer than 12 months in 1920, the reference year? Now, these must be adjusted for 12 months. So if we had a 15-month accounting period, we turn over, say, 45,000, then we divide by 15 and multiply by 12, and we get a reference period turnover of £36,000. It makes sense. You're trying to compare like with like, so 12 months with 12 months. If that method does not produce a fair result, then an alternative method may be used. Now, what if the accounting period was shorter than 12 months in 1920? Well, once again, you've got to adjust to 12 months. Now, for example, if the taxpayer had an 8-month period with declared turnover of 16,000 on the 1920 and 12-month accounting period in 1819 with declared turnover of 24,000, then the 12-month reference period is calculated by adding 4 months turnover from their 1819 return, £8,000, plus 8 months turnover from the 1920 tax return. And this will give 24,000. So you're looking for turnover. So it's turnover per the accounts. That's what you're after. So how do we determine which grant is available, i.e. the lower one or the higher one? If we look at a higher grant example, let's say the 1920 reference year is 20,000 and the 2021 pandemic year is 10,000, the turnover has reduced by 50%, i.e. greater than 30%. So you get the higher grant worth 80% of 3 months average trading profits. If we had a lower grant example, we'd have 20,000 for the reference year, 1920, and let's say our pandemic year turnover was 16,000, then the turnover is reduced by only 20%, that is less than 30%. So we get the lower grant worth 30% of 3 months average trading profits. So a much lower grant, either 80% or 30%, depending on how much your profits have, or sorry, your turnover has dropped, not profits, it's turnover has dropped. Quick example of a taxpayer with more than one business. So let's say a taxpayer has two businesses with the following turnover. I've got business A and business B. So turnover is as you see on the screen. You add them together, business A and business B, and we get 50,000 for 1920, and we get 25,000 for 2021. The combined turnover has reduced by 50%. That's more than 30%. So you get the higher grant. So hopefully it's given you an understanding of what you need to do to assist your clients with their fifth SEIS grant. They're the ones that must be applying for it, but obviously the information from us to allow them to apply for it. We're still looking at the SEIS. HMRC are amending returns for misreporting of the previous grants. Now, payments from the first three SEIS grants, they must be included on the 2021 return in a specific box. Now, it's box 70.1 if you're doing the full self-employment pages, 27.1 if it's the short, 9.1 of the partnership page, or box 3 to 10A of the SA 200 tax. So there are specific boxes for the SEIS grants. You don't put them in turnover. Now, from the 19th of June 21, if the SEIS grants information does not match HMRC's records, for example, the box is blank, that you're supposed to put the grant in, then they are automatically correcting the 2021 returns and issuing revised SA 302 calculations. Now, taxpayers must obviously check these revised calculations, or we must do that for them, and consider if their return needs amending. For example, we might have put the SEIS grants incorrectly in turnover. So therefore, as far as we're concerned, we have reported it, but HMRC don't think we have, because the SEIS grant box is blank. So therefore, we need to correct our return, because we've double counted. Now, if an amendment was made prior to 19th of June, HMRC will make the correction to the original return rather than the amended one. So do be careful with this, because for starters, we should be reporting the grant in the right box. And just check if HMRC are amending returns, because they believe you've reported either the wrong amount. So we might report a grant of X. HMRC think it should be Y. Just check whether you're in agreement with the figures, obviously. Or maybe we put it in turnover, and therefore we've got double counting. Just a few points on areas outside of the big two that I was covering in this particular session. Now, the first one, we're going to look at the nature of expenditure. And this concerned Messrs. Elliott, Balnakiel and HMRC. Now, the partnership farmed sheep and cattle to be sold to other farmers. They had a Category A listed building, and that had been the general manager's accommodation. But following his death, the house became increasingly uninhabitable. In addition, the partnership also had a small one-bedroom outbuilding, the Beach Bothy, and that was last used way back in the 1970s. Now, they received an urgent work notice which required the house to be repaired. Now, both properties were then renovated to provide luxury holiday lets, a complete change. The farming partnership was dissolved, and a new partnership was formed to run the holiday letting business. Now, HMRC disallowed some £260,000 worth of renovation costs as being capital in nature. Now, let's went to the first tier, and the first tier decided that all of the renovation costs were capital in nature, not revenue. The repairs were necessary, but the level of work undertaken had changed the overall character and intended use of those cottages. And furthermore, but the partnership wasn't a holiday letting business, so they were incurring costs which weren't wholly and exclusively for their trade anyway. So this appeal, unfortunately, was dismissed. It does raise a slight concern that if we were going into the holiday letting business and we were spending significantly to get those properties ready for luxury holiday letting, for example, then HMRC are more inclined to look at, let's say, a significant amount going through the repairs column under under what's been disclosed on the returns. And we've got to be confident that what we spend is incurred in our holiday letting business. And I think it's more when we're starting to do it. If we've done it for years and we just need to spend some money on the property, I think that's fair enough. That will be fine. It's where you might have a buy-to-let and you decide to upgrade it and go into FHLs. It might be that you bought a rundown flat, which isn't really lettable, and then you upgrade it and go into FHLs. That's the areas you've got to be careful with. Obviously, this case was in the extreme, £260,000 worth of cost, but the principles are the same. A couple of HMRC briefs on VAT. The first one is 9/2021. It's provision of welfare services by private bodies that are not charities. Now, their services are only exempt from VAT if the body concerned is state regulated or a private welfare institution or agency. That's what the law says. Now, the VAT exemption does not apply to private welfare institutions or agencies which supply daycare services in England and Wales and are not state regulated. That's the change, or the announcement really. And this follows the Court of Appeal's judgment in the joint appeals of Life Service Limited and the Learning Centre of Romford Limited. Providers in Scotland and Northern Ireland are not affected by the judgment simply because under the devolved provisions they are required to be state regulated. In England they're not, and if they're not, then they're not going to get the VAT exemption on those daycare services. Another HMRC brief, 10/21. This brief announced a further extension to the Overseas Refund Scheme, otherwise known as the 13th Directive Scheme, that applies to overseas businesses not established in the EU and not VAT registered in the UK. So those businesses can submit 13th Directive claims to HMRC to get the UK VAT back that they've incurred. Now, applications for refund under the 13th Directive were or are for the year to 30th of June, and they must normally be submitted by the end of December. Now, due to COVID-19, the deadline for the year to June 20 was originally extended to 30th of June 21. This brief further extends the deadline to 31 December 21. So that is for your claim to 30th of June 20. You need to get that in by end of December 21. So full year extension because of COVID. Got a little case on partial exemption and attribution of costs, etc. This was the Royal Opera House, Covent Garden Foundation and HMRC. Now, Royal Opera House is a charity that stages ballet and opera performances. Now, they have a lot of exempt ticket sales, but they do have catering supplies, which are standard rated. Now, Royal Opera House claims some £532,000 worth of input tax, which they said related to the catering activity. They argue that there was a direct immediate link between the production costs and both the admissions, the exempt admissions, and the catering supplies. So when apportioning, they were getting quite a lot of cost back, which they said was in relation to their catering supplies, so some £532,000. That wouldn't have been directly on the catering activity. It would have been on general production costs, which they were then apportioning between the catering and the ticket income. HMRC said, no, the production costs are just in relation to the sale of the tickets. Why are you apportioning them to the catering? The case went to the first tier, and the first tier ruled in favour of the Royal Opera House. They said there was an economic link between the production expenditure and the catering services. The performances brought in customers who then purchased food and drink. Now, understandably, HMRC appealed, and they went to the upper tribunal. Now, the upper tribunal disagreed with the first tier and went down on the side of HMRC. And they ruled the production costs were directly and immediately linked to the performances. There was only an indirect economic link between the production costs and the catering supplies. Production costs were used to make productions. They weren't used to make catering supplies. They weren't a cost base of those catering supplies. So as far as the upper tribunal concerned, you couldn't link the production costs to a completely unrelated source of income. Royal Opera House appealed to the Court of Appeal. Court of Appeal agreed with the upper tribunal. And it's this attribution. You've got to have the the costs you're incurring having quite a decent link to the income stream. So in this particular situation, the catering was pretty much on its own. You bought in stuff to sell in the catering and you sold in the catering. It's very hard to have the general production cost linked to the catering element. Well, that concludes this business tax roundup for this month. My name's Dean Wootton. Thank you for listening.